Welcome. This is Annuity News Now. I'm Scott Drake. With the growing popularity of annuity products with consumers and financial institutions, we thought it might be time to offer an overview of just what an annuity is. My guest is James McKelvain in Arlington, Texas. James, welcome back.
Thanks. Glad to be here.
So let's just start with the basics. What is an annuity?
Well, an annuity is a contract between you and a life insurance company. And the reason folks use annuities in retirement planning is because of the number one, safety. Safety of their principal, safety of the interest that they earn. And that's guaranteed by multi-billion-dollar insurance companies, also guaranteed by the Guarantee Association in the state that you live in. Number two, the growth is tax deferred. Well, that's a great thing. We obviously know tax deferred is better than taxable. Number three is liquidity. If I need my money, I want to be able to go get it. And you can do that with an annuity. Number four, you can have an income that you can never outlive, a lifetime of income. And then lastly, the avoidance of probate is very attractive to folks.
James, you mentioned that an annuity can do away with probate. Can you explain that?
Well, nobody likes probate. Probate, you have to go before the judge. He decides if the beneficiary is the right beneficiary. It takes time. And with annuities, the named beneficiary, upon the date of death, will receive a check directly from the life insurance company. So a lot less time and money wasted on getting the money to where you want to get it to and who you want to get it to.
Now, why would somebody purchase an annuity as opposed to some other type of product?
Well, Scott, let's look at the other investment options that there are out there. Number one, you've got stocks and bonds. Man, it's great when the markets are up, horrible when the markets are down. There's risk associated with that. Number two, you've got mutual funds. Well, you can't lose any money in mutual funds. Have you heard people say that before? Because you've got all these funds to choose from. Well, you've got to make sure you pick the right one. Again, markets are down, usually the mutual funds are down. So there's risk associated with that. Then you've got CDs, which, again, we call that in the business going broke safely. Because by the time you factor in inflation and have to pay tax on the interest that you've earned, you really go backwards. So annuities offer, again, if you choose the right one, there's several types of annuities, one being a variable, which means exactly what it says. It can go up and it can go down, the value. Or you have fixed annuities, which are guaranteeing the principal and interest that you've earned.
With an annuity contract, how does one receive the payments?
Well, there's different types of annuities and different ways you can access the funds. If you access more than the penalty-free amount, there are surrender penalties for early withdrawal. But generally speaking, you can receive up to 10% a year penalty-free. Other contracts are more liquid and some are less. But you can receive those by writing a check. They'll give you a checkbook, or you can have them systematically deposited into your bank account once a month, or once in a while, once a year, twice a year. If you need funds, again, you can access them at that time with a one-time withdrawal.
Well, finally, what are the payment options to a beneficiary from the annuity contract?
Well, Scott, there's a lot of options, and if a beneficiary needs to take 100% of their money out, they're allowed to do that in some contracts. Other contracts, it has to be paid out over, let's say, 5-10 year period of time. And then others, you can keep it in there and let it continue to grow, and as you want it in the future, you can access the money then.
All right, James, thank you.
Thank you for having me.
That is James McKelvain in Arlington, Texas, and you're watching Annuity News Now.